Good day and welcome to this webinar. We're thrilled to have you join us for this online discussion. Elections will continue to dominate the democratic world in 2024. With the recent South African election, investors are naturally asking, what should my long-term positioning be during these uncertain times? Will the GNU be a catalyst for positive economic change in South Africa? And what will its impact be on undervalued South African assets? Multi-asset funds such as the M&G Inflation Plus Fund and M&G Balance Fund are specifically designed to provide investors with diversified exposure to help navigate uncertain times. So with me today in studio is Leonard Krüger, Equity and Multi-Asset Portfolio Manager at M&G Investment. And Leonard's going to tackle some of these pressing questions as well as address the recent performance and positioning of the M&G Balance and Inflation Plus funds. I'm Zyron, Melton, Client Director at M&G Investments, and I'm going to help Leonard unpack these issues and answer your questions as we go along. Again, thank you for your time and joining us for this and for participating in this discussion with us today. Leonard, let's start. What can we learn from some of the elections that have already occurred in 2024?
Thanks, Zyron, and thanks everybody for joining us. It's hard to believe we're in August already. When we started the year, there were lots of headlines saying that, more than half of the world's population is going to the polls this year. And, as things have progressed, there's been a couple of upsets and a couple of surprises already in the election outcomes. And we've got a couple of big ones still to come, which we'll probably talk about this morning. But what's been very interesting this year has not just been the market reactions necessarily to the election outcomes, which we'll talk about, but also sort of exploring how the different markets or the different countries, how their nuances in their electoral system have led to quite different and potentially, in some cases, surprising outcomes to the elections relative to the expectations. So the first one that I wanted to start with this today is to actually give you the UK example to just illustrate the difference between the way in which the people voted, the electorate, how many of them went to the polls. So in the case of the UK, out of every 100 people that are eligible to vote, the voter turnout was only 60%. So we had 60 people go and vote. And of that 60, 20 then voted for the Labour Party. That was the victorious party in the case of the UK. Now, the nuance in the UK example is that because they have what they call the first past the post system, so the person within your council or your constituency that gets the most votes, he automatically gets the full council. So when you then look at despite only getting 20% of the electoral vote, the Labour Party under the system ended up with 63% of the seats in the UK Parliament. Now, if you contrast that, say, to the Reform UK Party, they got essentially half of the votes that the Labour Party got, so 9 versus the 20 that the Labour Party got, but nowhere were they essentially the party in the majority of their respective constituents. So they ended up, despite getting a sizable number of votes, they ended up with less than 1% of the seats in the Parliament. Another example that happened now in July was the French election. In their system, they have a 2-round voting system. So if nobody gets a majority in the first round, you have to vote again a week later on the 2 leading parties. Now, in the French example, you had the Right National Party of Marine Le Pen getting the most votes in the first round, but all the centrist parties then subsequently formed a coalition for the second round, and despite not getting the most votes in the first round, the centrist parties ended up getting more than 60% of the vote in the French elections. So this is going to be important in the big one that remains to come for later this year in November, the US election. So remember they have what they refer to as the electoral college system, where it's quite plausible that we could have a scenario similar to what we've had before, where the person that gets the most votes don't necessarily end up winning the election. So they're looking at the swing states, the states like Pennsylvania, Wisconsin, Nevada, Arizona, Georgia. They're really going to be the main determinant of the outcome in the US election.
The battleground states, I guess.
The so-called battleground states, exactly. If we then switch to the South African example, our election outcome versus representation, because it's proportional, is a lot more sort of simplistic to understand. But in the South African case, we have a different dynamic at play, in that a very large percentage of the eligible electorate in South Africa actually have become either so disenfranchised that they don't bother to even register or vote, and those that have registered, a big part of them actually don't show up to vote on the day. So out of every 100 people that are eligible, or the electorate in South Africa, in the past election in the end of May, we saw only 39 actually end up in voting.
That's quite low.
That's a very low outcome in terms of participation in the South African democracy. What I've then added on this chart is just to show sort of the parties that fall under the Government of National Unity banner. They essentially got 28 votes, so that's about just over a quarter of the South Africans that voted for them. And the opposition parties of the EFF and the MK, they got 9% of the electoral vote. So quite similar to sort of the more right-leaning parties that we've seen in the case of the UK example in the previous one. If we then look at how that has translated into seats in Parliament, the Government of National Unity essentially got a very strong mandate from the Parliament point of view, getting 72% of the seats. The Progressive Caucus, as they refer to themselves, getting a quarter. But I think the real thing of importance, as optimistic or encouraging as we might look and feel today about the possibilities which we'll unpack around the formation of a government national unity, is we must understand that 61% of people in South Africa did not bother to vote at all. And because they didn't bother to vote, they are essentially unrepresented when it comes to Parliament. So whether we're looking at cases like the UK, the US eventually in November, or South Africa, even in cases where we seemingly have a strong mandate in post an election from the electoral outcomes, we need to keep in mind the fact that either people didn't vote, or the way in which the system has been designed, first past the post, two-round system, electoral college system, it can lead to outcomes that are not necessarily representative of the majority view in the respective countries.
Understood. But I guess one could make the argument then for South Africa, I guess, that those that chose not to show up on the polls in the day are basically, maybe supportive is too strong a word, but they are acceptant of the results of the electorate, right? I guess one could make that argument, whereas opposed to not having any sort of flaws in our design.
I don't think it's an issue around a flaw in design. I think it's really, those people want to see the political system and the country do something for them, essentially improve their prospects, and deliver on a promise for a better future. And really that's the opportunity as well as the risk, I suppose, with when you have a change in political dispensation, that when can they essentially deliver on these people that supported them for this change, but also the people that sort of want the change but haven't necessarily bothered to make the election vote themselves.
Understood. So on that note, I guess, what can the GNU mean for South Africa going forward? Like, what should investors be looking out for?
Yeah, so I suppose, I think the first thing to say is it's not going to be a straight line and an easy set of things to improve, to turn around on. But it is a very good foundation from which we as a country can essentially start a process of renewal, reform, and change that is desperately needed. And so I think it really is, I've used this analogy of sort of a chain reaction that essentially needs to get going to essentially start addressing a lot of the structural issues that we have as an economy. The first thing that has been very encouraging from the Government of National Unity formation is the re-emphasis and the reinvigoration of the reform agenda. And that's really happened in the first term of Cyril Ramaphosa already, but really moving that onto the next phase and continuing the work that has already been done. And that spans a whole breadth of areas. So most notably the state-owned enterprises, or the SOEs, and we'll talk about some of the progress that we've seen there. But then also in terms of legislative changes, making sure that South Africa is aligned with things like the AGOA Accord with the US, which gives us preferential trade access, addressing shortcomings in legislation like the NPA Act that's recently been signed. So lots of these sort of things that really needs to work on the foundation of the economy to really get investor confidence and consumer confidence and business confidence back in a process where it actually starts to move forward. Because what we've really seen is very low levels of investment, both from the man in the street, car sales, house sales, those sort of things have been very depressed relative to history. But also businesses have been reluctant to invest, to grow their businesses, or to go and expand. And it's really those things from the private sector, whether it's from the consumer or whether it's from private business, that really needs to ignite and get this chain reaction going so that we can ultimately start lifting economic growth. And only once you've lifted economic growth above the sort of the 0 to 1% that we've been sort of stuck at for the better part of a decade now, that we can start addressing some of the more structural issues, the likes of, job creation to address unemployment, education, healthcare. There's lots of issues that we all know about in the South African economy. So this waterfall chart is actually taken from sort of some of the work done by the Minister of the Presidency and the National Treasury, and really trying to put a number to the potential of what can be achieved if these barriers or these blocks in the economy is actually removed. And I think what's important from sort of speaking to the people in those offices that we meet with on a regular basis is that they've really de-emphasized the role of the state in a lot of this. So the growth of the state is not what they are looking to achieve this higher level of economic growth. It's really enabling the consumer or enabling business to grow this, to ignite the economy, and then get to that potential of a 3% or greater. But again, it's not going to be a straight line. It won't be easy, and it won't be overnight either.
Yeah, I guess that's why confidence is sort of the middle cog in that whole chain reaction there, right?
Yes, correct.
Yeah.
Correct.
Okay.
Yeah. If we look at a little bit of the sort of the state-owned enterprises, and this notion of the confidence and this investment that can ignite the economy. We're sort of 150 days now without load shedding, and long may it last. But I think what you can see, what I've put on these two charts, is really to illustrate the two poster children in terms of the underperformance of state-owned enterprises in recent years. So
poster children or problem children?
They're probably in the naughty corner, I would say. So the left-hand one looks at Eskom and the number of hours that we've had of load shedding over the past number of years. Of course, last year was absolutely horrific, very difficult. It's not just an inconvenience for you and me as people that live, but very, very difficult to do business and essentially keep your operations up and going. And then together, what I show with that is actually the energy availability factor, or the EAF. And you can see the reason for the load shedding has been this precipitous decline in the EAF factor. What we've seen, there was a lot of skepticism initially around, when load shedding didn't happen, was it an election ploy or anything? But, there's lots of public information data out there. And, we really do see an improvement in the underlying fundamentals operations of Eskom. So you can see this slight turn in the year to date of the energy availability factor. But more recently, we've sort of hit that magical 70% number in the most recent weeks from an energy availability factor. And when we look at sort of the medium-term planning of Eskom in terms of projecting the next 4 or 5 years of load shedding, their sort of high road essentially looks at an energy availability factor between 66 and 68% that's required, that will essentially, mean very little load shedding. So if we're at the 70-odd% level, we're certainly in a position where sort of just the security of the supply of electricity actually becomes available. Now, I use this as an example because the reform agenda was within the electricity provision was sort of paramount in some of those projects that I highlighted on the previous graphic. And liberalizing and allowing private sector participation, we've seen a massive installation of renewable projects, of solar panels at homes and those sort of things. So when we look at the actual demand for electricity also required from the state-owned enterprise, Eskom, that's also come down. So you've had two factors effectively at play. You've had reform allowing private sector participation. The private sector responded, and then you've had sort of a real focus on operational turnaround within Eskom, really illustrated by the electricity availability factor as shown there. The other naughty child, as you put it, would be Transnet, which is sort of more a business sort of restriction of late, and that's really been on the freight side. There's lots of metrics that you can look at here, whether it's the ports or the handling facilities or pipeline volumes, those sort of things. But using freight in this example, again here you can see how that has declined in recent years due to sort of problems with management, problems with the company balance sheet, and again here the reform agenda and allowing the private sector to become involved in the rail provision for coal, as an example. We're already starting to see a couple of green shoots there in terms of improvement. So we don't have the detail for the 2024 year there, but you can see just a slight uptick there. Already some improvement, admittedly off a low base, but we're getting there. And so really the point of this is, I say here it's the light at the end of the tunnel. We're still in the tunnel, no doubt, but there is a light flickering there, where the reform and the turnaround in state-owned enterprises just helps a lot to get us from a point where confidence and the need or the willingness to invest actually goes hand in hand. And this coincides then with the formation of a government of national unity, where we actually have a bit more certainty for the next couple of years, at least in terms of what the political environment might look like and what their intentions are.
Yeah, one could argue, looking at your slides here, that things started turning around before the government of national unity was instituted, but I guess it's positive then that these things will keep going then.
I think what's really positive is with the formation of the government of national unity, it's been re-energized and reinvigorated and re-emphasized as sort of a priority and a realization that this is the way to go forward, and where the area of focus really needs to be from a government's sort of task list point of view.
Understood. Leonard, I think we've now touched on the political situation, but I guess a question that we got a lot from the audience is rates, right? And sort of interest rates are sort of the baseline for any valuation-based investor like ourselves, right? To form prices. So what's the house's view on rates and where it's likely to go?
Yeah, so we don't try and typically make a prediction in terms of where interest rates are going to go. I think globally, when we stand back and we look at where we are in the rate cycle globally, we're more likely at the top than we are at the bottom, and the next move is likely to be down. So I think what you can see here on this graph is the South African repo interest rates, where they've been over the last sort of 25 years, and we're at the highest point that we've been since the global financial crisis. So this is an additional lever where, the consumer, you and I, we've got car loans, we've got home loans. We've been paying more for our disposable income's been under pressure over the last couple of years. What you then see from sort of what the market is expecting in terms of rates going forward, that's illustrated with the forward rates, so that little yellow bit there. And you can see, I think if we're going to go into a cycle where rates are going to be eased globally, some of the central banks have already started, like the Europeans, the UK last month also had their first rate cut, and the US is likely to follow suit. South Africa will probably move in the same direction. What's interesting then from coming back to our portfolios and how we build our portfolios, when we look at in multi-asset, we've got this whole opportunity set of different asset classes that we can build from. When we look at what the South African bond market implies future cash rates needs to be to essentially be the same off, that's what I've illustrated here with the blue line. And so what the bond market versus what the cash market is telling us is that, the cash market is saying rates are going to go down, but the bond market is saying if you want to do as well being in cash going forward as you will do in the bond market, that is what your cash rates will need to do. And although it's not impossible, I would make the argument that it's fairly improbable, looking at the recent history and where the world finds itself today, that our cash rates out to 2035 is going to look like that, as opposed to the more recent past.
Yeah, I don't think anyone wants that for their home loan, right?
Quite right.
Yeah. I guess maybe if we could turn to returns, right? We'd be remiss not to discuss point out the fact that the multi-asset high equity and both multi-asset low equity funds have had a tough time of it, especially when compared to the interest-bearing category and both the multi-asset income category, right?
Yeah.
I guess the question there would be, and the question that we've gotten from the audience, when will we see a sort of return to a more normal risk-return relationship?
Yeah. So, I mean, it's obviously very difficult to predict, when things will start to happen, but it's certainly been the case. If you look at the series of returns that we've got on this chart here, it's a very unusual picture to see high equity portfolios like the Balance Fund really, either underperforming over a 1-year time period or even over something like a 10-year time period where the returns are very similar to sort of an income type of portfolio. And we'll unpack some of the reasons, but it's really essentially been a big part of the risk-adjusted return that you need to get from equities that haven't delivered in recent years. What I think is a positive picture, essentially, what we've got on the screen here, is that despite this period of South African equities underperforming relative to their long-term history or expectations, we've had returns above inflation, irrespective of the portfolio that it's been, and the MNG funds within their respective categories over the longer time periods have performed very well. Something like a balance fund over 3 years have done 10.2%. That's better than 4% better than inflation over that time period, when the benchmark, which is the average manager, has done a percentage point less than that. If you look over the longer time periods, then you can see that those returns are very close together, and we would expect a sort of that typical risk reward to be better remunerated over the longer term. Yeah. Maybe the one area to call out here is in the shorter term. The Balance Fund, you can see, has underperformed relative to its benchmark. That's primarily been down to two specific reasons. We have held less offshore assets than the average offshore portfolio, due to some of the more optimistic views on the outlook for South Africa, which, has the potential to now come to the fore given the political dispensation and where valuations are. But then within that, also within South Africa, the equity selection has detracted a little bit, where we haven't held some of the more sort of racy names, the ones that have been very popular in the local narrative in terms of having done well, where we've been more biased towards sort of the cheaper valuation companies, where we think, the market has taken a wait-and-see approach in terms of execution as opposed to buying it ahead of time.
Yeah, so that'd be the likes of Capitec or...
So Capitec would not be in the portfolio, and it's done exceptionally well. It's a very good business, but we struggle with a valuation that is demanding quite a lot in terms of the future execution from Capitec from here.
So where have we deployed capital instead?
Yeah, so I mean, we hold a host of the different banks. We hold a lot of the domestic retailers, and they've done well. They've added value, but they perhaps just haven't done quite as well as the likes of a Capitec has done. We've also deployed quite a bit of money in the resources space towards the diversified miners. We own quite a lot of gold in the portfolio, given the strength of the gold price, sort of $2,500 odd an ounce. So they're going to be making very good money at these prices. And yeah, so again, I think sort of always with a multi-asset portfolio, the really beauty of it is the vast diversification that we build into these portfolios. Obviously, we still hold the sort of the long-term, very attractive names, the likes of the Naspers process. We have some Richemont in there. MTN is a big turnaround story within that as well.
Okay. Maybe I think that 10-year number, there's a lot in there, but you touched on it, sort of equities and the return from equities is sort of the story there. Maybe could you give us some more detail there, some more color to that?
Yeah, sure. So let's go to that slide there. I think it's, as I alluded to, it's been a tough decade for South African equities. Typically, over the very long-term history that we've got data for since 1900, so it's like 120-year data. That's illustrated by the yellow line there. Apologies. You can see that the last 10 years, the real returns from South African equities, this is including your dividends, just hasn't been nearly the same level in terms of that long-term average. And it's really only post-COVID 2021 where you saw a year of strong equity returns. The 2017 was really the Ramaphosa phase one, followed by sort of the realization that markets had become overexcited in 2018. So it's been a very tough decade for South African equities in terms of the real returns. But when we drill a little bit deeper into that, and we do equities on a 10-year view, so we take sort of a truly long-term view by decade, and we analyze where the returns have come from, you always get your returns from two main sources. It's, are the companies growing their profits, and what is the market willing to pay for those profits? So either what's the price to earnings multiple, or what's the price to book multiple. So if we look at that first component of what have been the earnings delivery from companies listed in South Africa and available for us to invest in, you can see that the earnings delivery has been very normal and almost exactly what they had been in the decade prior, ending 2013, or even the decade before that, ending 2003.
So that's the blue bar, right?
So that's the whole stack. But then within that, you can see we break the whole stack down between inflation, real growth, and the dividend that you've essentially gotten. So the blue bar just talks to the growth better than inflation, and you can see it's been very similar. It's sort of that 2.5%, what you would normally expect, which I think surprises a lot of people in that it's been a very tough decade, low growth as we've spoken about, but the companies have got on with it. Obviously, within this component, there's a lot of companies that have done better than others and others that have done poorly, but you always have winners and losers in any market.
Yeah.
It's then when we take that second component of the returns of the PE multiple that either increases or decreases, that gets you your equity return that we see in our fact sheets at the end of the day. And what's been notable over the last decade, ending 2023, has been this very large derating that we've seen in South African equities. So we've gone from a PE, sort of call it 15, 16 times, to below 10 times where we sit today. And that's caused a more than 5% headwind on the returns per annum. Now, to your earlier question, when you asked sort of, when can investors expect to see this return, effectively what you're really asking is, when does the PE contraction end?
Yeah.
And that's very difficult to predict. But what we do know is that PEs over the very long term is a mean reverting series. So even if the PE multiple doesn't go up, but it just stops falling, already you'll get those returns that I showed on the previous chart of sort of early to low double-digit returns, as opposed to the 8.8% return that we've had.
Yeah, so I mean, it just doesn't need to derate, even if there's no change in rating, it should be favorable, right?
Yeah, so just a stop in the derating will see returns improve, obviously with the caveat that earnings are maintained, and that's what we spend our whole day looking at, determining where the companies are that have got the best earnings prospects and sustainability of their respective earnings.
Okay. Understood. I guess maybe to say on this chart, right, we're not making a prediction here. This is
all historical fact.
Yeah, historical fact. Yeah, we're not saying that we're expecting a earnings re-rating or a re-rating in stocks. It just happens to be that over the last decade they have flipped between de-rating and re-rating. I guess.
Correct. So I think that potentially talks to sort of that one cog that we said is so important, sort of that confidence cog that really has an amplifying effect on GDP growth or sentiment in the economy. But likewise, you could probably apply that to the market. If there's a better sense of confidence in the stability of the way in which the country is run and operated, and people are willing to make investments, you can see this de-rating essentially cease. And who knows, the upside to all of this is a potential re-rating to the longer term average.
Yeah. So could this, I guess the next question then, could this see sort of a rebirth of the multi-asset low equity, high equity funds, as opposed to the multi-asset income or interest-bearing category that we've seen sort of attracting all the flows?
Yeah. So I mean, that's what I call the 1 trillion rand question, in that when we look at the industry level statistics, the enormous amount of investor capital that has flowed into interest-bearing or income funds over the past number of years. So this is statistics from ASISA, publicly available, and you can see that it's been 4 times the level of flow into these interest-bearing type of accounts, as opposed to into the traditional multi-asset portfolios. And where we sat at the end of 2023 has been that, those two categories, when we sum them together, now both essentially sit with around about 1 trillion rand of assets under investment. And that means South Africans have a lot of exposure to interest rates at this point in the cycle. And our earlier conversation spoke to sort of the likelihood of our interest rate cycle actually going down as opposed to go up. So sort of relief for the consumer on their debt, but quite a headwind for the saver that's essentially not going to earn the same type of interest rate on their savings as before. Now, the beauty for me within that is that as a multi-asset fund, whether you're in Inflation Plus or the Balance Fund, we've got the flexibility to move our portfolios, which in the case of the Inflation Plus Fund has got a massive amount of exposure in bonds and cash and fixed interest, and move that towards sort of areas where we think the returns could potentially be better.
Okay. So on that note, I guess maybe we can say, where are you seeing the best opportunities right now for multi-asset fund?
Yeah. So I think if we look at sort of the whole suite of available products or available asset classes, I should say, we're actually quite spoiled for choice, particularly in South African assets. So I made the case now previously for the equities, but really when we look at the real returns on offer, in our opinion, across South African assets today, they're quite nicely and handsomely above where we think the long-term fair value for these asset classes are. So to use an example, let's stick to equities as an example. You can see the prospective real return that we can buy on the market today is 9%. The long-term average that I showed earlier as well, and where our fair value is sort of, we demand around a 7% real return from equities, an example. And you can go through this whole list and you see that there really is opportunity right across the spectrum. So it makes for very robust debate internally when we sit as portfolio managers to decide, essentially when to pull the trigger to take more risk when there is so much opportunity. I think what is sort of a stark difference is if you compare the returns available in South Africa to sort of the rest of the world. Now, the world's a big place and there'll always be pockets of opportunity, and we certainly try and exploit that in our offshore allocations. But the world as a whole, you can see both from a bonds as well as an equity point of view in real space, those returns don't look as attractive or as abnormal, as compelling as the South African case. So if we then switch to just look, how have we positioned our portfolios as at now, looking at the prospects for what an improved sentiment towards South Africa can possibly mean. Critical for us always, as I've said earlier, is to have this diversified exposure and to get the balance right between having risk assets, safe assets, domestic assets, offshore assets. So starting with the balance fund there, you can see about a third of the portfolio at the moment is invested offshore. So that would be a combination of equities, cash, bonds, credit, a little bit of property internationally. But really, focusing the bulk of the portfolio in South Africa, and within that, in the South African equity space. So 44% of the portfolio, for example, in South African equities at this point in time. Really sort of, I think, mirroring what you saw on that previous chart with the returns that are on offer, to really, exploit the best future risk-adjusted returns.
So essentially 44% of the portfolio exposed to a potential 9% real return.
That's right. Yeah. That's how you should do it. And you can essentially do those sums for each of the individual asset classes. That does not mean that the returns are guaranteed to be that. And it doesn't mean that that would be the return every single year. It will be a volatile number, and news happens, events happen all the time, unexpected things happen. But I think what it does show us is that the odds are in our favor at this point in cycle, particularly given sort of the early positive momentum that we can see as a country in terms of a stabilization of state services, stabilization in terms of the politics, certainty in terms of sort of where we will be for the next 4 or 5 years until we sort of go into a next election cycle. I just quickly want to touch also on the right-hand panel, so the inflation plus portfolio. This is the low equity multi-asset portfolio, so it will always be a little bit more conservative. I alluded to the fact that it holds more bonds, given those very high bond returns that are on offer. So half of the portfolio is in bonds, and about a quarter of the portfolio is invested offshore. And within that, we tend to hold a little bit more offshore bonds as opposed to offshore equities, due to that diversification benefit that you typically see for the more risk-averse investor, to provide a level of diversification and offset in the event that equity markets being volatile takes a wobble, as we've seen they can very easily do in recent weeks. So that's a very nice offset in a portfolio like the Inflation Plus portfolio.
Yeah, so quite different exposures, I guess. Quite a different makeup of funds. I guess the asset classes seem a bit more split in Inflation Plus, but obviously a different target there. And then on the balance fund, we can see sort of leaning a bit more into the foreign portion of the portfolio.
Yes.
Any comments on sort of what some of that foreign equity is made up of, or what's looking attractive to us at the moment?
Yeah. So in the foreign equity side, I think one of the sort of the longer term themes within the portfolio has been sort of keeping keeping a fairly cautious approach to the US. So US markets, they've really been the driving force. And within that, particularly sort of that tech sector, the Magnificent Seven have been big drivers. So we've been fairly cautious and underweight relative to the world market in the US and those specific big names on average. We do own some of them in the portfolios. And we've really taken that capital and invested in other areas where we see more attractive prospective returns. So things like other developed markets, Japan might be in there, a little bit of the UK, see a lot of opportunity in the European financial sector, but then also a lot of opportunity in other emerging markets. So I think, when we have our discussions with our colleagues in London, we're encouraged by the fact that they also see value in emerging markets like we see value in South Africa, which is an emerging market. So within that space, we'll have a little bit of exposure to the likes of China, Mexico, Taiwan. Korea still classifies as an emerging market for historical reasons, but they would be in there as well.
Okay. I guess maybe we should turn to some of the questions that we got from our audience during registration. Cyril, Kevin, and Ursula, as well as Lubalalo, asked that they have concerns about coalition governments and specifically the track record of coalition governments in South Africa. Obviously, Gauteng and Joburg comes to mind here. What are your thoughts on this, Leonard?
No, so I think that is right. I think that's why you probably haven't seen a similar market response to the Ramaphosa 1.0 thus far. I think the market has sort of woken up and realized that this is not going to be an easy task. South Africa, like you say, does not have a whole bunch of experience when it comes to coalition governments and working together. And I think the reality is that, the parties within the government of national unity are very diverse in their opinions and their views of how things should ultimately be run and managed. So I don't think anybody should be under any illusion that it's easy. I don't think we should be under any illusion that it won't be noisy, that it will just be a smooth, straight line. And there probably will be moments of noise and infighting and headlines being made in the news. I think what's been encouraging has been sort of the very clear willingness and maturity of the most senior people in the respective parties to actually be supportive of this and committing themselves to want to make it work. I think we've reached a point where sort of the politicians also realize things need to change, and you can see that through the voting behavior of the public. A very large proportion of them haven't showed up to vote. A very large proportion of them have switched their votes from how they voted previously. So new upstart parties have in very short time managed to gather a large percentage of the vote. So I think the sort of the main parties, the ANC and the DA and the IFP within, they're sort of the traditional parties within the GNU, I think they've seen their support base sort of erode, and their remaining supporters really advocating for change and cooperation, and a need for things to progress.
Yeah. For people to work together.
People to work together.
Yeah. Andrew, JC, and Kevin asked about the grey listing, the grey listing of South Africa. Specifically, they want to know how this impacts foreign investment and if the GNU will prioritize having South Africa removed from the grey list.
Yeah, so I think it is certainly a priority. I think there has been a lot of positive sort of feedback that we've certainly heard from sort of the financial authorities that are very much involved with this. I think the finance minister has sort of fairly recently been quoted as saying, there's a window of opportunity for South Africa, perhaps in early 2025, to have this be reconsidered. So there's a lot of the
the action items have already been addressed. So it most certainly does appear like it is quite a high priority for South Africa to be removed from the grey listing. Has it affected potential investors? That's difficult to tell because I think there's a lot of other factors also at play. South Africa hasn't had a very favorable story to tell for quite some time, and I think this was just a sort of another blotch against our name. Importantly, South Africa is going to be the president of the G20 in 2025. So we as a country are going to be very much in the news, in the limelight, on the front foot, and having a better story to tell, showing progress in terms of reforms, whether that would be on the legislative side, whether that would be the grey listings, those sort of things, or just a political will to improve, could be very positive. And that, together with removal of grey listings and attractive valuations as we've seen, that could very much attract foreign investors in large amounts, both the financial kind, investing in markets, but also the real world kind that invest in infrastructure on the ground, building businesses, buying businesses. And that's been very lacking from South Africa for a long time.
Yeah, thanks, Leonard. Another one that we've got in a lot is, and it's a very topical one for our industry, and that's the TwooT saving system. Some general views on this and the potential impact it could have on markets, and then potential impact on investors as well.
Yeah. So I mean, it's a big topic for us in the industry, and a lot have already been said about it. So, I mean, there are three main areas to essentially tackle this question. Is firstly what it means. So from the 1st of September, the TwooT effectively becomes sort of in motion, and investors or people in retirement funds, pension funds will have up to 30,000 Rand available for withdrawal. We think in the long term that's a good piece of legislation to drive the long-term behavior of clients that have historically not retained their pension savings when they've changed jobs. So we've seen very low levels of retention. So under the new TwooT, you'll see a compulsory retention of 2/3 of your future contributions. Just because the TwooT allows you to take your savings component or the initial up to 30,000 Rand seeding, it doesn't mean that please do not necessarily you have to take it. There are tax consequences to these sort of things. So that's from the client consumer point of view. The second one is sort of administratively and how we think about the portfolios and managing the portfolios. The work that we've done, we don't think it is quite even though it's a big thing in the retirement space, we don't think it's quite big enough to essentially impact the way in which we need to manage the portfolios in terms of liquidity or asset allocation or any of those sort of bigger question marks. This will be a normal operational implementation for us from a managing the portfolios and handling clients' requests to withdraw money or liquidity. So I don't think that has a material impact. And then the third one that is sort of very interesting to think is what does it mean in the economy, and what could it potentially mean for markets, and are there industries that could potentially benefit? So we've had a couple of case studies around the world. So the likes of Chile or Peru or Australia have also had cases where they've allowed some kind of access to pension fund money, whether that was during COVID or during other time periods. And typically what we saw in those instances is quite a bit of money leaving the system, at least initially, getting into the pockets of the consumer. So either paying down some of the credit card debt, reservicing your loans, which would be a very positive thing to do, I suppose, if you're in a financially distressed situation, or potentially on the consumer side. So just enhancing the amount of spending that is out there. Again, here I think so. Even though you've had those case studies, I would not get too overexcited about the potential of what this might mean for, a Mr. Price in terms of how much spending could be coming to the market. You should remember, clients or savers were already accessing their money previously through this resignation and very low retention. So there is a pool of money at an economy level that is already in circulation, and we're really talking about the incremental rands that might now be available. So it's certainly something that we'll be watching over the next couple of months, see what the companies are saying, whether they see anything on the ground. But we are ready from an operational point of view. We're hoping clients do the right thing and only access it in true emergencies as opposed for consumption, because that's just longer term, not in your best interest. And then, whether that gives rise to investment opportunities or not, we'll see. But I don't want to make a whole investment case based on it at this point, I don't think.
A bit unclear, but we'll have to wait and see, right?
I think so.
Yeah. Awesome. Thanks, Leonard. The other big question we got in was national health insurance, and you cover the insurers like Discovery and the like. What's your view on that and the impact this might have on South African businesses? Or
so I think the very first thing to say is that in the current form that is proposed, it won't have an impact on private sector healthcare for a very long time. So we're talking way past 2030 in terms of having an effect on your medical aid or the companies that administer or manage your medical aid. That being said, I think sort of already what we've seen from a government of national unity point of view is a renewed willingness to engage with the various participants. There's lots of objections to it. Clearly, affordability is a massive issue. It's unaffordable if the economy remains in this 0 to 1% growth sort of paradigm. So you really need to get that chain reaction of economic reform, confidence, investment, growth going to then even start contemplating around implementing what is a noble intention of universal healthcare, and nobody objects against that. But the affordability and the way in which it gets implemented, I think there's a lot of work left to do. And even though President Ramaphosa signed it prior to the election, it's not been promulgated, and I think it will go back to have an extensive review and consultation process again.
Okay, good. I'm conscious of time, and so maybe if we just take one last question from our audience, and that was on Japan, and Pasi asked sort of basically what has happened in Japan more recently, what's triggered it, and what's our general view on Japan?
Yeah, so the first part of the question is quite a difficult one because there are probably more theories than there are truth. So what we've seen is sort of quite a correction in Japanese markets, and a even as rapid recovery in the market subsequently. So the Japanese currency, the yen, has been very weak. It's been weak for a couple of years. Lots of potential, what we refer to as the carry trade, so people effectively borrowing in yen and investing in other markets because interest rates are very low, and then the yen has been on a pretty steady depreciation sort of pathway, and what we've effectively seen is a little bit of a wobble in the market in terms of the Japanese increasing their interest rates by sort of 0.1%, and the threat of the US essentially, starting their process of decreasing rates. So you really see that gap between the two essentially squeeze. And so one of the main theories is a very large unwind of this carry trade. That's in the short term. I think longer term, we have been, and we continue to be, very constructive on the reform in Japan. They have reform issues very different to South Africa, but they've also been stuck in an economic malaise for quite some time. So a lot of reform in Japan, particularly around their equity market, in terms of forcing companies and company management to take action in cases where there are large cross-shareholdings, where there are very inefficient balance sheets, where the companies have been hoarding a lot more cash than what is required of the business. So, and that's really been coming from a regulatory government stock exchange point of view, rather than the typical Western style shareholder activism that would be typical. So being a very consensual society, we're seeing real progress and real momentum from Japanese companies around sort of unlocking and undoing the spaghetti bowl of cross shareholdings and lazy balance sheets and unlocking value. So with events that we saw over the past couple of weeks, these sort of sporadic spurts of high volatility, we've typically tried to use that as opportunities to increase our position in markets where we see much longer term tailwinds on the impact that reform can have on a market.
Excellent. Thanks, Leonard. We are running out of time, and if we didn't get to your question today, M&G representative will reach out to you and try to answer your question directly. Leonard, I think I'm going to hand over to you to provide us with some concluding thoughts and maybe close off the webinar.
Yeah. Okay. Thanks, Zyron. So I thought maybe just to try and put it in a short conclusion slide for you, the things that we were talking about today, and summarize it. Is firstly that there's been a lot of political noise and news and geopolitics around the world. So we monitor it, we're aware of it, it's been very elevated. Typically, elections don't have enormous impacts on markets over the long term, but I think there have been instances this year where that has not been true. So, and South Africa is an example of a real opportunity for South Africa to turn a corner under a government of national unity. We're very encouraged by the initial signs. It won't be easy, and it won't come in a straight line, but the improvements are really required to catalyze this chain reaction of improved sentiment, improved investment, improved growth, and then we can start addressing the structural issues. From a interest rate cycle point of view, we're seemingly at the top of the cycle, and rates are likely to come down. This is good news for the economy. It enables investment, it enables consumers. But in the savings markets, we've seen huge shifts towards these interest-bearing type of assets, and they will be less well off when rates come down, and their returns will suffer as a consequence. Equities have not delivered for the past decade, but the underlying companies have actually delivered very nicely. So earnings have come through as we would expect and as they have done in the past. And it's really been the derating of markets that have dragged down the returns. And if that derating just stops, the prospect for returns going forward are very positive. Our portfolios have done well, and we've done better than inflation over all time periods. So our clients are better off for being invested with us by staying the course, and we're looking to find opportunities. And the returns from here still offer attractive prospective returns, and we think we can deliver better returns over the longer term than what has been the case in the recent past. But that is situation dependent, and we will react and change the portfolios as needed as these opportunities present themselves. So that's it from my side. Thanks very much for joining us, and speak again soon.
Thanks so much. Goodbye.